The data is screaming at us from every single direction today. And 3 days ago, a specific ledger entry in the Shanghai Gold Exchange confirmed exactly what we have suspected. China has officially activated a massive protocol that effectively shifts the entire global financial axis overnight. This is not a drill, and we are looking at a fundamental restructuring of how global capital moves. We are witnessing a $634 billion movement of capital that main media ignores. While New York slept, Beijing executed the first phase of a 7-piece strategy that corners the market. The numbers we are seeing on the screen are not just record-breaking, they are absolutely system-breaking. This is the Economic Alerts channel, where we expose the hidden truths that others are afraid to touch. If you want to stay ahead of this financial curve, make sure you subscribe to the channel right now. We track the flows that Wall Street ignores, and we bring them directly to you before the crisis hits. Today, we are exposing the 7-piece strategy that is now live and changing the rules of the game. For years, analysts whispered about China's potential to decouple from the dollar, but it was just a theory. That is no longer a theory. It is a mechanical reality happening in real time before our very eyes. The first piece of this complex strategy is what we identify as the Treasury Dump operation. Official data released by the U.S. Treasury Department this week confirms a historic low in foreign holdings. China AAS holdings of American government debt have dropped to $682.6 billion. This is the lowest level since 2008, so think about the implications of that specific date. We are back to great financial crisis levels of exposure, but the context today is entirely different. In 2008, China was buying to save the system, but in 2026, China is liquidating to exit it. They are selling U.S. debt at a pace that suggests a strategic exit rather than a tactical rebalancing. This is not about profit-taking. This is about asset swapping on a massive geopolitical scale. Every dollar released from a treasury bond is not going into cash, but into hard strategic assets. It is flowing into gold and industrial silver, and the speed of this rotation is unprecedented in history. We are seeing a systematic liquidation of paper promises in exchange for physical reality, which changes everything. This leads us directly to the second piece of the strategy, which we call the shadow reserves. The official numbers from the People's Bank of China are a diversion designed to mislead Western analysts. They report reserves sitting around 2,300 tons. But this is a fraction of reality. Our analysis of customs data, mining output, and import flows suggests the true number is exponentially higher. Conservative estimates now place China's state-controlled gold reserves above 5,000 tons, hiding the true scale. Some institutional models even point to 10,000 tons, which would rival the official United States holdings. Why the discrepancy? Because if China admitted they held 10,000 tons, the price would revalue overnight. They need the price suppressed while they complete the accumulation phase, which is the silent accumulation phase. They are buying the dip and the rip, but they are doing it through unlisted proxies and banks. State-owned banks and military-linked investment vehicles are involved, so the gold enters China but stays off book. It disappears into the vault network, creating a floor under the gold price that Western short sellers cannot break. Every time the paper market in New York tries to smash the price, physical buyers in Shanghai absorb it. This creates the third piece of the puzzle, the Shanghai Premium, which is now a permanent market feature. For the first time in history, we are seeing a persistent divergence between prices in the East and West. Gold in Shanghai is trading significantly higher than gold in London or New York, creating a massive vacuum. We have seen spreads reaching $40 to $50 per ounce. And this is not an arbitrage opportunity. It is a vacuum sucking physical metal out of Western vaults and shipping it east to never return. Refineries in Switzerland are working overtime to melt down Western bars and recast them into Chinese kilobars. They ship them directly to the Shanghai Gold Exchange for immediate delivery, draining the COMEX and LBMA. This is a one-way street where the metal leaves the West and creates a permanent transfer of real wealth. This brings us to the silver component, because silver is the Achilles heel of the modern green economy. China knows this better than anyone, as they control over 80% of the solar panel supply chain. Solar panels require silver, lots of it, and the new generation of cells uses even more than before. China is not just buying silver for money, they are buying it for industry and securing strategic feedstock. This is the fourth piece called industrial capture. And by dominating demand, they control the global price mechanism. Western markets treat silver as a speculative token, but China treats silver as a strategic national security mineral. The difference in approach is stark. Western investors trade paper while Chinese state enterprises take physical delivery. We are seeing massive withdrawals from the Shanghai vaults where inventory levels are dropping while imports surge. Where is the silver going? It is going into stockpiles and factories. removed from monetary circulation forever. This creates a permanent deficit that the Silver Institute projects for the 6th consecutive year, signaling a crunch. This is not an accident. It is engineered scarcity because China is draining the global swamp of available silver. When the Western investor finally wakes up to the shortage, the metal will already be gone to Asia. It will be sitting in a warehouse in Guangdong or pasted onto a solar cell in the Gobi Desert. The leverage this gives Beijing over the West is immense, allowing them to throttle the green energy transition. We have already seen them restrict exports of gallium, and silver is the next logical target on the list. The market is mispricing this risk entirely because traders are looking at interest rates instead of supply chains. They should be looking at shipping manifests because the physical flow of metal tells the real economic story. The story is that the West is being drained, which brings us to the 5th piece, retail mobilization. The Chinese government has effectively crowdsourced their gold reserves by encouraging citizens to buy physical metal. They promote gold beans, miniature bars, and jewelry, mobilizing the population's wealth into hard assets immediately. The people, Bank of China, does not need to own all the gold if the people own it. In a crisis, that gold is within borders and can be mobilized to stabilize the internal currency system. The Chinese saver has lost faith in the property market and the stock market, leaving only one option. There is only one asset class left that they trust, and that is physical gold, driving massive demand. The demand we are seeing from the Chinese retail sector is astronomical and absorbs domestic production entirely. China is the world's largest gold producer, yet they export virtually zero gold because it stays domestically. On top of that, they act as the world's largest importer, creating a black hole for precious metals. The retail mobilization ensures that the yuan typically stays within the gold ecosystem, reducing capital flight risks. If a Chinese citizen buys gold, they are not buying dollars and they are not moving money offshore. They are keeping the wealth within the bamboo wall, supporting the currency while weakening the dollar's influence. It is a defensive moat built of bullion, but the strategy gets more aggressive with the 6th piece. This is the digital bridge, also known as the M-Bridge project, a central bank digital currency platform. China is integrating gold into this digital architecture, creating a mechanism where trade surpluses settle in gold. Saudi Arabia sells oil to China and receives digital yuan, which they can immediately convert into gold. This effectively creates a gold-backed petroleum, removing the risk of holding fiat currency for trade partners. It incentivizes oil producers to move away from the petrodollar, and this is happening right now in real time. The volume on M-Bridge is growing rapidly, and the connection to the gold window is the killer app. It offers hard money settlement in a digital wrapper, and the West has no equivalent system currently. We are still using the SWIFT system, which is a slow, expensive messaging system built decades ago. The M-Bridge system is instant, settlement final, and efficient, and with the gold link, it is totally trustless. You do not need to trust the Chinese government. You only need to trust the physical gold delivery. This brings us to the 7th and final piece of the strategy, which is the most controversial. It is what we call supply chain weaponization, because China processes the majority of the world's precious metals. Even gold mined in Africa often flows to China for refining, giving them control over industry bottlenecks. If they decide to tighten standards or slow the exports of refined bars, the global market freezes. We are seeing signs of this, and supply chain weaponization is the ultimate trump card in this war. It turns gold and silver into geopolitical tools, proving they are instruments of state power, not just commodities. The 7 pieces work together. The Treasury Dump funds the accumulation, and the shadow reserves hide the scale. The Shanghai Premium attracts the flow, while industrial capture squeezes the supply and retail mobilization locks wealth. The digital bridge facilitates trade, and supply chain weaponization protects the flank, creating a closed-loop system. It is designed to be impervious to Western sanctions, functioning without the dollar to win the long game. The implications for the American investor are profound because the transfer of wealth is already underway today. It is flowing from the printer to the producer, from the paper to the physical, moving east rapidly. The timeline for this strategy is not 10 years out. It is 2026, and it is happening now. The acceleration in the last 3 months is what triggered our alert, as data points align perfectly. We have never seen such a coordinated effort across so many vectors, implying a war-footing economy. They are preparing for a financial conflict, or perhaps they are already fighting it in the vaults. The invisible war is being fought on the ledger, and the casualty is the purchasing power of dollars. We are going to dive deeper into the mechanics of the Treasury Dump in the next section immediately. We need to understand exactly how they are selling without crashing the market, because that is the trick. If they sell too fast, they devalue their own holdings, so they have to sell into strength. Who is buying what China is selling, and what happens when the selling stops and liquidity dries up? That is the moment of truth when the gold price is unleashed because the artificial prop is removed. We are watching the countdown clock as the shadow reserves are filling up and the trap is set. Before we analyze the mechanics of the dump, subscribe to Economic Alerts right now because you need to understand exactly how this liquidation engine works before it crushes your portfolio. We track the flows that Wall Street ignores, and the Treasury Dump is not as simple as selling bonds on the open market, because if China dumped $600 billion of debt overnight, the global system would collapse instantly. They are using a much more sophisticated method that disguises the flow of capital completely, utilizing a network of offshore custodial accounts to mask their selling activity. The primary hub for this activity is located in Brussels, specifically through the Euroclear system, which explains why official data often shows China S holdings remaining relatively stable, while the data for Belgium shows massive unexplained fluctuations in volume. These are the proxy sales that allow Beijing to exit positions without alerting the general public, transferring ownership of the bonds to a Belgian custodian who then sells them slowly to prevent a sudden spike in yields that would devalue the bonds they still hold. It is a stealth exit designed to drain liquidity from the American system drop by drop. But the question remains, who is buying the debt that China is aggressively selling? The Federal Reserve is not officially expanding its balance sheet to monetize this specific debt, so the buyers are largely leveraged hedge funds engaging in what is called the basis trade. They borrow money in the repo market to buy treasuries and short the futures contracts, and this arbitrage trade is the only thing holding the U.S. government bond market together right now. It is a fragile structure built on massive leverage and very thin profit margins, and if the repo rate spikes even by a few basis points, this trade blows up. China knows this, and they are feeding the supply into this leveraged, unstable machine, effectively weaponizing the greed of Wall Street against the stability of Washington. We are seeing a massive rotation of capital that is unprecedented in modern financial history. And the capital that leaves the Treasury market is not sitting idle in cash accounts, but is moving directly into the industrial capture phase that we mentioned in the beginning. This is where the strategy shifts from financial maneuvering to total industrial dominance. And we need to talk about silver because it is the most undervalued asset in existence. The industrial demand for silver is exploding, driven entirely by the solar photovoltaic sector, as China has transitioned its solar manufacturing from P-type cells to N-type cells this year. This technical shift sounds boring, but it is financially explosive for the silver market because N-type solar cells, specifically TOPCon and HJT technologies, require significantly more silver paste. Our analysis shows that silver consumption per watt has increased by nearly 50%, and with China doubling its solar installation targets for 2026, the math becomes impossible. They are consuming more silver than the entire global mining industry can produce annually, and the deficit in the silver market is now entering its 6th consecutive year of shortages. Above-ground stockpiles in London and New York have been drained to critical levels, and China is aware of this physical limit, so they are cornering the remaining supply. They are engaging in offtake agreements directly with miners in Mexico and Peru, bypassing the COMEX exchange entirely to secure physical metal at the source, which effectively removes that supply from the global market before it ever reaches a vault. The Western price discovery mechanism is broken because it tracks paper, not metal, and while the spot price fluctuates, the physical premiums in Shanghai tell the real truth. Factory owners in Shenzhen are paying massive premiums just to secure delivery of silver paste because they know that without silver, their solar empire comes to a grinding halt. This is why the industrial capture is not about speculation. It is about survival, and China is securing the lifeblood of the energy transition while the West sleeps. The 7-piece strategy uses this scarcity to create a geopolitical choke point, meaning if the United States wants to build its own solar manufacturing base, it needs silver, but if China controls the refining capacity and the mining supply, America is blocked. We are looking at a future where silver is treated like uranium or oil, becoming a strategic national security asset that is hoarded by governments rather than traded by speculators. The Treasury Dump funds this acquisition, turning paper debt into strategic energy dominance, and every bond they sell buys them more control over the future of global energy. It is a brilliant, ruthless strategy that solves two problems with a single move. It reduces exposure to the dollar and increases control over the physical world. The shadow reserves we discussed earlier are also being filled with this industrial silver, and we have reports of state-owned warehouses stocking millions of ounces of industrial bars. These are not the shiny investment bars you see on television or websites. These are rough 1,000-ounce industrial bars destined for the melting pot, and they are being taken out of circulation, effectively reducing the global tradable float. This tightening of supply is invisible to the average investor, looking at ETFs because the ETFs hold paper claims on metal that may or may not exist, while China holds the physical metal in sovereign territory under military guard. The difference between a paper claim and physical possession is becoming the defining theme of this decade. And as we move deeper into 2026, this divergence will cause a market fracture, the basis trade. Keeping the Treasury market alive is nearing its breaking point because the sheer volume of supply coming from the East is overwhelming the leverage capacity. When that trade breaks, the Federal Reserve will have to step in as buyer printing trillions of dollars to absorb the debt China is selling, and that money printing will trigger the second wave of inflation that we are predicting. And that inflation will drive the price of gold and silver even higher, creating a feedback loop that Beijing has engineered to destroy the dollar's purchasing power. They sell debt, force the Fed to print, and watch the dollar devalue against gold, which increases the value of their gold reserves while devaluing America's debt. It is a financial jujitsu move that uses our own monetary policy against us, and the Shanghai Premium acts as the magnet that accelerates this entire process. It constantly pulls metal out of the West, leaving us with only paper derivatives, and we are witnessing the hollowing out of Western financial markets in real time. The assets are leaving, and the debt is staying, which is a recipe for disaster. The retail mobilization ensures that this gold and silver never leaves China again, because once it is sold to a Chinese grandmother, it is removed from the global market. It goes into a private stash, passed down through generations, and stays local, creating a permanent sinkhole for precious metals that cannot be filled. The West continues to suppress the price, thinking they are controlling the market, but low prices only allow China to buy more metal for every dollar they sell. They are using the suppression to accelerate their accumulation of real assets, and it is the greatest wealth transfer in history executed in broad daylight. Most analysts are looking at the stock market oblivious to the foundation crumbling beneath them. They see the S&P 500 hitting highs and think everything is fine, but they do not see the liquidity draining out of the sovereign bond market. They do not see the physical shortages developing in the industrial metals complex. The digital bridge is the infrastructure that will replace the dollar system. And while we touched on mBridge earlier, we need to understand its true power. It is not just a payment system, it is a settlement network for commodities that allows countries to trade oil, gold, and goods without touching the U.S. banking system. This neutralizes the threat of sanctions, which is America's primary weapon, because if you can trade globally without dollars, the dollar loses its exorbitant privilege. China is building this lifeboat because they know the dollar ship is sinking, and they are punching holes in the hull with the Treasury Dump to speed it up. The data from the Belgian custodians is the smoke from the gun. The soaring premiums on the Shanghai exchange are the bullet hole, and the American economy is the target that is unaware it has been hit. We are approaching the moment where the damage becomes visible to everyone, and the supply chain weaponization is the final blow that locks the door. By controlling the refining of gold and silver, China holds the keys, and they can dictate the terms of delivery, the purity standards, and the price. The London Bullion Market Association is losing its relevance every single day, and the center of gravity has shifted to the Shanghai Gold Exchange permanently. This is not a cycle, it is a secular change in the world order, and the flows we are tracking confirm that this strategy is fully operational. There is no turning back for China. They have crossed the Rubicon and have committed their entire financial system to this transition away from fiat. The Treasury dump will continue until their exposure is effectively zero. The industrial capture will continue until they control the solar supply chain, and the gold accumulation will continue until the dollar breaks. You need to look at your own portfolio through this lens immediately. Are you holding the assets that are being accumulated or liquidated? The smart money has already moved following the path of the central banks, and the 7-piece strategy is a roadmap for the collapse of paper money. It is a warning siren for anyone holding traditional financial assets, and we are going to explore the geopolitical consequences in the next section, because when a country dumps your debt, they are declaring financial war. And financial war often leads to kinetic consequences in the real world, and the tension in the Taiwan Strait is directly linked to these gold flows. You cannot separate the money from the military in this scenario. They are two sides of the same coin, and the coin is gold. The supply chain weaponization extends beyond just precious metals. It includes the rare earth elements needed for missiles and radar, the chips, the batteries, and the raw materials of war. China is securing all of it, paid for with the dollars they are dumping. We are funding our own encirclement by buying cheap goods for decades, but now the bill is coming due, and the currency is being devalued. The Treasury dump is the mechanism of payment for this new order, and we must understand that the selling is not a panic. It is a plan that has been executed with patience and precision for years. And now the pace is accelerating, and the window to react is closing. The geopolitical consequences of this financial maneuver are not just theoretical. They are flashing red on every strategic dashboard in Washington, because when a superpower dumps your debt while hoarding the resources needed for war, they are signaling intent. We are watching the formation of a sanction shield that is designed to make the Chinese economy immune to the kind of financial weaponization that devastated the Russian economy in 2022. Beijing studied those sanctions carefully, realizing that their reliance on the dollar and the SWIFT system was a critical vulnerability that had to be closed before they could make any definitive move on the geopolitical chessboard, specifically regarding Taiwan. The 7-piece strategy we have outlined is the closing of that vulnerability, effectively building a financial fortress where trade can continue, energy can flow, and the economy can function, even if the West completely disconnects them from the dollar network. This is why the Treasury Dump is coordinated with the digital bridge. They are removing the leverage the United States holds over them, meaning that when the next crisis hits, American sanctions will be like firing blanks at a tank. The M-Bridge platform allows them to settle trade with the Global South, Russia, and the Middle East using gold-backed digital currencies, completely bypassing the New York clearinghouses that enforce U.S. foreign policy. This renders the primary weapon of the United States, the ability to freeze assets and block transfers, obsolete. And once that weapon is neutralized, the calculus for war changes dramatically in Beijing's favor. We must look closely at the military implications of industrial capture, because this is where the finance war meets the kinetic war. Modern warfare is entirely dependent on advanced electronics, and advanced electronics are entirely dependent on silver and gold. Every Tomahawk missile, every F-35 fighter jet, and every satellite in orbit requires substantial amounts of high-purity silver for guidance systems and gold for corrosion-resistant connectors. By cornering the physical market for these metals, China is not just squeezing solar manufacturers, they are squeezing the U.S. military-industrial complex. We have already seen delays in defense production due to supply chain shortages, but imagine a scenario where China explicitly bans the export of refined silver to the United States. The strategic stockpile of silver in the U.S. was sold off decades ago, leaving the Department of Defense reliant on the open market, a market that is now being drained by our primary adversary. This is a level of strategic negligence that borders on treason, yet the buying continues in Shanghai, locking up the very materials needed to defend the West. The supply chain weaponization is the ultimate siege tactic, starving the opponent of the resources needed to fight while sitting on a mountain of them yourself. This is why the premiums in Shanghai are worth paying for Beijing. They are paying for national security and strategic superiority. The impact on the American consumer will be immediate and brutal when this strategy reaches its climax in late 2026. As China dumps treasuries and the Federal Reserve is forced to print money to buy them, the supply of dollars in the system will explode, triggering a second, more violent wave of inflation that will make 2022 look mild. But this time, it will be coupled with a supply shock as cheap Chinese goods stop flowing or become significantly more expensive due to currency alignments. The retail mobilization in China means their citizens are protected by gold, while the average American is exposed to the devaluation of the dollar. You will see the price of imported goods skyrocket. Fuel prices detach from reality as the petrodollar dies, and the purchasing power of your savings evaporate in real time. This is the great leveling, where the standard of living in the West is forced down to meet the rising East, a transfer of wealth that is mathematical and unavoidable given the current flow of funds. The media will call it supply chain disruptions or transitory inflation, but you will know the truth. It is the result of a deliberate multi-year strategy to break the dollar's hegemony. The shadow reserves give China the confidence to let their currency float or even back it partially with gold, a move that would instantly dethrone the dollar as the world reserve currency. If the yuan is backed by gold and the dollar is backed by debt, which currency will the world choose to hold? The answer is already visible in the actions of central banks around the world who are buying gold at the fastest pace since 1967. They are voting with their balance sheets, following China's lead and exiting the dollar sphere of influence. This is the Global South rotation, a secondary effect of China's strategy where countries like Brazil, India, and Saudi Arabia join the gold for trade ecosystem. The 7-piece strategy creates the gravity that pulls these nations into Beijing's orbit, isolating the G7 economies and leaving them to trade paper amongst themselves while the rest of the world trades real things. We are witnessing the bifurcation of the global economy into two distinct blocks, the financialized West and the resource-backed East. The West has the debt, the derivatives, and the brands. The East has the gold, the oil, and the manufacturing capacity. In a prolonged economic conflict, the side with the resources always wins because you cannot print oil and you cannot print gold. The illusion of wealth created by the stock market is about to collide with the reality of resource scarcity, and the collision will be catastrophic for unprepared portfolios. You need to understand that the window to position yourself ahead of this shift is closing rapidly because the silent accumulation phase is nearly complete. Once China announces their true gold reserves, perhaps revealing 10,000 or even 20,000 tons, the price of gold and silver will gap up, never to return to these levels again. That announcement will be the checkmate moment, the signal that the accumulation is over and the revaluation has begun. At that point, buying physical metal will be nearly impossible. The premiums will be hundreds of %, and the inventory will be non-existent. We are already seeing the signs of this with the Shanghai Premium, which is the early warning smoke before the fire. The dealers are running low, the mints are backlogged, and the smart money is taking delivery now, not waiting for the headline. If you are sitting in cash, you are the liquidity that they are draining. If you are sitting in bonds, you are the bag holder for their exit. The only way to opt out of this system is to do exactly what the central banks are doing. Trade your paper promises for physical reality. Get out of the counterparty risk chain and own assets that do not rely on the solvency of a bankrupt government. The narrative that gold is a barbarous relic is the propaganda used to keep you in the dollar system while they exit. They tell you to buy tech stocks and bonds while they buy bars and coins. Look at what they do, not what they say. The Treasury Dump is the loudest action a nation can take, screaming that they have no faith in the future of the dollar. Why should you have faith in it if the world's second largest economy does not? The industrial capture of silver is a screaming siren that the energy transition is being hijacked. Why are you not securing your own position in the metal that powers the future? The 7-piece strategy is not a conspiracy theory. It is a compilation of verifiable data points, customs records, and central bank statements that paint a unified picture of a world in transition. The era of the petrodollar is ending, and the era of the petroyuan and the gold trade note is beginning. The friction of this transition will generate heat, inflation, conflict, and volatility, but it will also generate massive opportunity for those who are on the right side of the trade. This is the most critical financial alert we have ever issued because the timeline is compressed. This is not a 10-year projection, but a 2026 reality. The pieces are live, the flows are accelerating, and the trap is set. We have dissected the strategy from the bond market to the silver vault, showing you the mechanics of the wealth transfer. Now the responsibility lies with you to act on this information. Do not be the investor who looks back in 5 years and says, I saw the signs but did nothing. The signs are here. The Shanghai Premium is here. The Treasury Dump is here. The game has changed, and the new rules favor the holder of physical assets. This is the Economic Alerts channel, and our mission is to wake you up before the reset is finalized. We will continue to track every ounce of gold moving east and every bond being sold in the west. If you found value in this deep dive, if you want to survive the shift that is coming, you need to be part of this community. Subscribe to the channel, hit the notification bell, and share this script with anyone who cares about their financial future. The storm is coming, but for those who are prepared, it is the opportunity of a lifetime. The strategy is live. The clock is ticking. Secure your wealth now.